Before you put another dollar into any investment account, you should be able to answer one question. What exactly is the difference between an index fund, a mutual fund, an ETF, and a hedge fund? If you can't answer that clearly, someone in the financial industry is benefiting from your confusion. And the frustrating part? The confusion is not accidental. These four products are deliberately marketed in ways that make them sound more different from each other than they actually are. Because the more complicated it seems, the more likely you are to pay someone else to figure it out for you. This video cuts through all of it. Four products, real differences, real fees, and the honest answer about which one actually makes sense for most people building wealth from scratch. By the end of this video, you will know exactly what each product is, what it costs, and who it was built to benefit. An index fund is not a company. It is not a stock. It is a vehicle, a container that holds a collection of stocks designed to mirror a specific market index. The S&P 500, for example, is an index, a list of 500 of the largest publicly traded companies in the United States. An S&P 500 index fund simply buys all 500 of those companies in the same proportions they appear on that list. When Apple goes up, the fund goes up. When the broader market drops, the fund drops with it. Nobody is picking winners. Nobody is making active decisions. The fund just mirrors whatever the index does. This is called passive investing. And it is the single most important phrase in this entire video. Passive means no active manager, no research team, no army of analysts. And because there is nobody actively running it, the cost of operating an index fund is extraordinarily low. The average index fund expense ratio sits around 0.03% to 0.20% annually. On a $100,000 investment, that is $30 to $200 per year. That is the entire cost of owning hundreds of companies across the entire market. Most people hear that and immediately ask, what about ETFs? Because they keep seeing both mentioned and nobody ever explains the actual difference clearly. An ETF, an exchange-traded fund, sounds like a completely different product but is functionally almost identical to an index fund in most cases. The one real mechanical difference is how you buy it. An index fund is purchased directly through a fund company at the end of the trading day at that day's closing price. An ETF trades on a stock exchange throughout the day, exactly like a share of Apple or Tesla. You can buy it at 10 a.m. and sell it at 2 p.m. if you want to. That flexibility is the primary distinction. Most ETFs are also passively managed, tracking the same kinds of indexes as index funds, and they carry similarly low expense ratios, typically 0.03% to 0.25%. For someone building long-term wealth, the practical difference between a broad market index fund and a broad market ETF is negligible. The financial industry markets them as separate categories. For most investors, they are nearly the same tool in slightly different packaging. Matt owns a total market ETF and a total market index fund in two different accounts. They do almost exactly the same thing. He does not lose sleep over which one is better. Where the real money flows, and where the fees start climbing, is mutual funds. Same basic concept on the surface. A pooled collection of investor money buying a basket of assets, but with one critical difference. Most mutual funds are actively managed. That means a professional fund manager, supported by a research team, is making deliberate decisions about which stocks to buy, which to sell, and when. The theory is that a skilled manager can outperform the market through superior research and timing. The reality, consistently demonstrated across decades of data, is that most actively managed mutual funds do not outperform their benchmark index over long time periods, especially after fees are accounted for. And those fees are significantly higher than index funds. The average actively managed mutual fund carries an expense ratio of around 0.5% to 1.5% annually. Some go higher. On that same $100,000, you are paying $500 to $1,500 per year for active management that statistically is unlikely to beat the passive alternative. That gap compounds over time exactly the way we broke down in the last video. The same math, the same 30-year drag, the same outcome that surprises people when they finally run the numbers. Jack owned 3 actively managed mutual funds for 6 years before he looked up their expense ratios. He had been paying an average of 1.1% annually without ever consciously choosing to. The funds came recommended inside a 401k plan. He had never once been told what they cost. This is not unusual. It is standard. Hedge funds are a different conversation entirely. And for most people watching this, a largely irrelevant one. They are legally restricted to accredited investors, people with a net worth exceeding $1 million excluding their primary residence, or an annual income above $200,000. Hedge funds pool capital from wealthy individuals and institutions and use sophisticated, often aggressive strategies. Short selling, leverage, derivatives, concentrated positions to attempt to generate returns regardless of what the broader market is doing. The fee structure reflects this entirely different tier. The industry standard is called 2 and 20, a 2% annual management fee on total assets plus 20% of any profits generated. On a $1 million investment, that is $20,000 per year in management fees alone, before the fund has done anything. And then 20 cents of every dollar of profit goes back to the fund manager. The data on average hedge fund performance against simple index fund returns over long periods is not flattering to the hedge fund industry, even before fees are taken into account. They are worth understanding not because most people will ever own one, but because knowing what they are makes it easier to see why the simpler, cheaper alternatives are not the inferior choice. They are just the less profitable choice for everyone except the person actually investing. Pull all 4 back and the picture becomes clear. Index funds and ETFs, passive, low cost, built around the idea that most investors are best served by owning the market cheaply and consistently. Mutual funds, same structure, active management layer added, significantly higher fees, decades of data showing most fail to justify the cost. Hedge funds, aggressive strategies, restricted access, the highest fees in the industry, built for a completely different financial tier. The question worth sitting with is not which of these products exists. It is which one was designed with your interests as the primary consideration. Most people building wealth from a standard income and a long-time horizon will find that the simplest, cheapest, most boring option outperforms the more complex, more expensive, more impressively named alternatives over time. Not because the other products are fraudulent, because fees compound, simplicity scales, and the market is harder to beat consistently than the financial industry's marketing budget would have you believe. The next video breaks down exactly how to build a simple, low-cost portfolio using these products. What to own, in what proportions, and why most people overcomplicate a decision that does not need to be complicated. Subscribe so you don't miss it. Drop a comment below. Before watching this video, did you know the real difference between all 4, or was at least one of them blurry?